Hey folks, Dan Bird here with the Daily Scan for November the 13th, Thursday. And we have a down day today. So is the bear creeping up, getting ready to attack? Market's on the edge. Let's find out. The tension mounts. I'm not a financial advisor, so this is for educational purposes only. I've got a lot to cover today. So let's get started. It is 11:25 a.m. on the East Coast right now. Let's take a look and see what's going on with the markets. Even though the shutdown has ended, I said before, the market doesn't really care about the shutdown. In fact, it probably likes that there's a shutdown and the Congress is divided and now it's open again and the market's going down. So there you can see the gap down this morning. This is the S&P money flow. Notice the tops on the money flow as we go through the week. Yesterday, it went up, but I said yesterday that there was no conviction in the market. And now we've got a little bit of conviction to the downside. So money flow is heading negative. Technology, these are all the aggressive sectors. Technology, discretionary, both down versus the S&P. So there's rotation out of the aggressive or the growth groups. Communications services is pretty much flat for the day, but it's been down for the last week, roughly. If we look at the defensive sectors, they are moving up. So there's the rotation. This clearly shows you rotation. The S&P right now is below Monday's open. So we are negative for the week right now. Staples are up, utilities up. Real estate is pretty much flat. And for the cyclical sectors, they're up as well. Financials up, healthcare, industrials is flat, materials, this is where gold is, it's going up again, and energy is getting a nice run today as well. So let's look at the rotation, growth versus value, continuing to go down. You can look back here a week ago, just continued, went down all week last week, and then on Monday we had that gap up. So it tried to get back up, but it never made it back to the highs from the previous week, and now it's continuing to move down. So there's rotation. This is something that's subtle and under the covers in the market that most retail traders will not know, will not be able to see this. They'll think that the market is just continuing to go higher, but in reality, there's rotation going on out of the growth areas and into the value areas. Same thing with discretionary versus staples, heading down, technology down, semiconductors down, and Dow transports are pretty weak as well. Let's take a look at the next one. This is breadth for the S&P. Had a nice run the last couple of days, now rolling over a little bit. And notice the S&P now is below the 21 EMA. So if it ends there at the end of the day, that will be very weak. That will not look good for the end of the week. Next week is options expiration week. So Max Payne comes next week. Here is the Russell 2000. Looks actually much weaker even than the S&P. So there's the gap down, continuing to go lower right now. This is the Russell versus the S&P. So this tells you whether your money is better off in the Russell or better off in the large cap S&P. And clearly today it's better off with the S&P. Although mid caps are hanging in there and small caps are not really selling off as much, but in general, overall, mid and small caps are underperforming the large caps right now. And there's the breadth for mid caps. You can see they're also below the 21 EMA, just hanging on to the percentage above the 20, hanging on to the 50. It's actually 51.67 right there. You can see the number over here on the left. And 50 is below the 50% level and small caps looks the same. Here is the NASDAQ 100. It's actually looking the worst of all of them. There's the gap down. Here's Monday's open, clearly below that. Try to make a run in the first half hour, 10:30, and then rolled over. Money flow continuing to go lower. Up volume versus down volume is negative. Advancers minus decliners is negative. The VIX is starting to move up, which you can see down here. Still below 20. It's at 19 right now, but it's in that neutral zone between 17 and 20 and moving higher. So you can see the trend line down here, the VIX continuing to move up. So all of this implies that there is weakness and rotation. The the breadth in the NASDAQ 100 looks worse than all of them. Again, it's below the 21 up here, percent above the 20, 50, and 200. 20 and 50 are both below 50%. So this is the NASDAQ 100, which means the percentage is the same as the number of stocks. In this case, there are only 38 stocks that are above their 20-day and only 44 stocks that are above their 50-day. The rest of that 100 is below those levels. The 200 is still okay. It's at 56%, so it's above 50. But notice bullish percent index started to move up the last couple of days, but now it's rolling over as well. So all of this is pointing to more weakness in the market. Let's look at the dashboard real quick. The Dow, which had been the strongest one, is rolling over a bit today. It's still doing better than the S&P, but it is starting to roll over. Here's the VIX down here. You can see the VIX is really taking off. So that's implying that the market is rotating and getting weaker. Bonds, 10-year bonds are higher. The dollar is lower. It's actually good for stocks. Commodities, gold, hanging in there, basically just treading water, going sideways, but it had a really good run in the last week. And oil is moving slightly higher as well. On the crypto side, Bitcoin is down 101. So we'll look at Bitcoin in a second. That is a really key level when we get down here to 199 in particular. I talked about that yesterday. Ethereum is declining more than Bitcoin. So down 1.38 versus 0.53. And down here you can see energy. I showed this before. Energy is the winner for the day. It's only 3 of them that are positive: energy, healthcare, and staples. Staples is a defensive sector. At the bottom are all 3 of the aggressive sectors, all bringing up the rear. And over here you can see large cap growth is the big loser for the day. Everything's red. The best performer, interestingly, is large cap value. So there's the rotation. You can see it right there, out of growth into value. That is not a good look for the market in general. All right, NVIDIA is next week. Applied Materials reports tomorrow. Let's see, the ones that have already reported. Cisco had good earnings yesterday, although it doesn't show it here, but I read something that showed that it had good earnings. It actually says it's down 26% right here. Let's see what Cisco looks like. Yeah, it had a big gap up, but has a shooting star candle right now. So that could be a reversal, but had looks like a really good report this morning. Yesterday had huge volume going into the report, so somebody knew something was coming. And then a big gap up today for Cisco. All right, let's go back and take a look at down here. You can see on the 3 charts side by side, S&P sitting right on the 21, very, very important level. The Russell is well below the 50, and all of the moving averages. The 8 has crossed the 21. The 21 is getting ready to cross the 50. That's the 8 and the 21 is the short-term change. So you can see right here, that's the short-term down signal. And when the 21 crosses the 50, that's the medium-term down signal. So that one actually looks very weak, weaker than the S&P. And Bitcoin looks very similar to the S&P. I've talked about this before, that Bitcoin and the S&P and the NASDAQ 100 are all highly correlated right now. So what one does, the other one will likely do as well. And one person said that Bitcoin actually might do 3 or 4 times what the S&P does, which is probably true. Although the charts look very similar, almost identical actually. So Bitcoin sitting right there. Actually, that's the S&P. So for some reason, let me go back and I'm going to do this in real time and see if I can put the right chart here. Let's go here. First, I need to know what group I'm in. And we'll do that this way. Sorry, getting a little bit of an education on stock charts. So it's the chart list is A3 index charts. That's what we're looking for. So we'll go over here and look for A3 index charts and look for Bitcoin right here. That is not Bitcoin. All right, I'll have to fix that later. Sorry. We'll do Bitcoin a different way. Let's go back here and we'll go to the market bias charts and look at Bitcoin over here. And it will look different than the S&P chart. So there's what Bitcoin looks like, sitting right down here, right above that really key level that I talked about last few days, or hit down here 3 times in a row, heading back there again. It's got a downtrend line in place right now. So for this to have a change of character, it needs to get above that downtrend line, above the 21 essentially. And this is a really key area, that 99,000 level. It's at 101 right now. So keep an eye on that. It's important that it stays above that. All right, I want to look at a couple of charts that people have asked me about. One is Costco. I'm going to do that here because it's part of this Magnificent Seven. And you might say, well, why is it in the Magnificent Seven? Well, that's because if you look at the top 10 stocks holdings in the triple Qs, you'll see that Costco is number 14 right down here. Actually, sorry, number 12 right here. AMD just dropped to number 13. So those are pretty much in the same order. I try to keep it that way, although it may get out of alignment slightly, but I will try to keep them in this order. But Costco right here is number 12. So that's the reason you see it on this list down here. And if we look at Costco with a zigzag chart, you can clearly see the downtrend. So the question was, is Costco at a bottom? Would this be a good time to get in? Well, and also the comment was because the accumulation distribution is in a bullish divergence, meaning it's going up as the price goes down. And you can clearly see that here. So this down here is accumulation distribution. And what I'm doing, this gray line behind there, if you can barely see it, is the actual line for accumulation distribution. And what you see are moving average lines. And what I'm using is an 8 and a 50. So the 50 is the red line and the 8 is the blue line. And that gives you a sense for what the direction looks like. And yes, clearly there is more accumulation going on. Now, not only is there accumulation, but as we're hitting these lows down here, these next lows are actually at a higher place than these previous lows. So they're continuing to move up, which is nice. It needs to break this downtrend line, but this actually might be a good place for an entry into Costco if you believe in the company and you think that it's going to continue to perform. It's actually doing pretty well today, even though the rest of the market, the S&P, is not. So yes, this could be a good place to get in. We'll look at this on a longer term like this. So there's that support line right down here. You can see it's putting in some higher lows. That's the beginning of a character change. That gets confirmed if it puts in a higher high. And to do that, it needs to get above this downtrend line. So that really is the key. There's nothing to say that it will get above that. It could easily go back up here and get rejected again. But it looks like it's just beginning. And notice the volume down here as it's hitting these lows right through here, volume is very weak. So there's practically no sellers down here. So this probably is a pretty good place to get into Costco with the understanding it's probably a pretty low risk area as well, because you can put a stop just below, basically right down here at 900. Let's see exactly where this is. This is at 901. So yeah, you could put a stop at 900, get in here. Right now it's at 921. And it's about 20 points down. So low risk, looks like it's starting to change character. Has not confirmed that yet, but it is moving in that direction. So thanks for asking about Costco. Costco looks very, very interesting right here. The other one that somebody mentioned to ask me about was S.gov. And I did a little research on this, and this is very interesting. They said, is this a good place to park money if you want to move out of the market and just move into cash? Well, there's the chart. You can pretty much see it does nothing but go up. Now, it doesn't go up very fast, but it certainly would be a good place just to park money if you want to, if you think the market is ready to roll over and you want to move to the sidelines. This is a good place to do it. This is an ETF, so it trades just like a stock. So very liquid, very easy to get in and out of. Now I compared this to another one that I talked about previously, which is not an ETF, it's actually a mutual fund. It's called SWV as in Victor XX. That is a Schwab mutual fund. And so I did a comparison between the two right here, SGov versus Schwab Value Advantage Money Fund. So one is an ETF, one's a mutual fund. The difference is with an ETF, you trade it just like a stock. So very easy to move in and out. You can trade it on Thinkorswim. The money market mutual fund, however, is a mutual fund. So you can't trade it on Thinkorswim. You would have to go to your basic Schwab account and move your money into the mutual fund. Now this is a 1-for-1, so this is basically $1. So if you had, let's say, $20,000, then you would buy 20,000 shares of the mutual fund. It has to be done on the regular Schwab account, not in Thinkorswim, and it does not complete until the end of the day. So you won't see it until the day after. Whereas with the ETF, since it's just like a stock, it happens immediately. So that's the slight difference between those two. Might be a little easier to get in and out with SGov. Now, which one would be better? Well, SGov is solely U.S. Treasuries, short-term U.S. Treasuries, whereas the mutual fund has a lot of U.S. Treasuries, but also has commercial paper and CDs and repos. So this one is subject to potentially credit risk, even though very small credit risk. Price behavior trades around $100 per share, small fluctuations, and this one is just $1. So however much money you have, you buy one share, basically. Liquidity, bought and sold just like a stock. This one here is redeemable directly with Schwab, $1 a share, but it's overnight before you see it. This one has monthly dividends. This one has daily dividends credited monthly. So monthly dividends is pretty nice. Daily dividends, even though it only gets credited monthly, is pretty good as well. Risk profile, very low risk backed by U.S. Treasuries. This is SGov. The mutual fund, also very low risk, but slightly more exposure to non-treasury, meaning exposure to credit risk. Use case, short-term cash parking with intraday liquidity, very easy to move in and out. This one is cash management with stable, NAV, and daily income. Very similar, just the difference in how you actually execute them. So which one pays out better? SGov, ideal if you want treasury-only exposure, with the ability to trade intraday like a stock. And the mutual fund, if you want stable NAV and daily income, functioning more like a traditional savings vehicle. SGov may offer slightly higher yields. So SGov actually might be a better one to park money in, just slightly better. So here, this shows you the yield. SGov dividend yield is 4.2, whereas the mutual fund is 4.14. So SGov wins on that score a little bit. SGov tracks short-term U.S. Treasuries. I talked about that. Very liquid for SGov. Bottom line, SGov slightly ahead in yield right now, 4.2 versus 4.14. So it really is your own preference. Yield comparison, you can see each one of these. So it depends on how you want to do it, and how you trade it is slightly different. But SGov actually looks pretty good. So thanks for the person that suggested this. And it looks to me like SGov might even be a better vehicle because you can sell it like a stock when you want to move back into the market, but you can move your portfolio into it and get 4.2%, which is not bad. So that's one way to manage your money as you're trading. All right, thanks for that one. That's SGov. So the next question was regarding covered calls, especially for two particular stocks. So the first thing I want to point out is, for those that have been watching the YouTube channel, I have a playlist called Technical Tuesdays, and I try to put the topics in here, but if you'll notice on this one right here, so here's the top of the list. This is the one that I just did, 11/4. I'm going to start putting the date so that's easier to find. But down here, using technicals for covered calls, 45-minute session. It'll teach you about how to use technical indicators for covered calls right here. But let's talk about covered calls, especially in particular for those two stocks. And I'll show you the stocks here in a second. First thing you have to understand, and we're going to go here on the website to the options page. First thing to understand with covered calls is that you are a seller of covered calls. You are not a buyer of the calls. So if we look at these really important charts right over here, if I click on it, you actually get a bigger view. So this shows you that as a seller, if you're selling a call, it's a bearish call, which means you think the stock is going to go down. If you are selling puts, on the other hand, it is a bullish call. So it's counterintuitive of the way you typically will think about options. As a seller for calls, it is bearish. As a seller for puts, it is bullish. The important thing to understand is this time decay. So if you will look at this chart right here, if you are a buyer of calls, the premium decays over time, and it accelerates in the last 30 days. You see it decays slowly at first and then accelerates at the end. So if you are a buyer of calls or puts, you want to have as much time as possible, because this will decay much more slowly. So you're hoping that your price gets hit. Your price actually has to be above what you're targeting. So if you got a $100 stock and you buy a call for 110, you need it to go above 110 to cover the premium that you're paying, and that premium decays over time. However, if you are a seller, this premium decay works in your favor, because as a seller, you're basically acting as the insurance company. So when you insure your house, for instance, each year, you pay a premium to the insurance company. As long as your house doesn't burn down, the insurance company just keeps the premium, and you do it again the next year. You keep paying premium to the insurance company. Well, as a seller of an option, you are the insurance company. So you get paid the premium from other people that want to buy the calls. You are paid the premium. And as long as that stock stays above or below whatever your target price is, then you just keep that premium. That's how it works. So as a seller, you're selling premium. Think of it that way. And if it expires worthless, you keep all of it, keep all the premium. So you actually want it to expire, and you want a shorter term usually if you are a seller of options. So that's the first thing to understand. The next thing is, for selling covered calls, remember, this is a bearish call. As a seller of covered calls, covered means you own the stock. So let's go and take a look at one of the examples. This example, and there's two reasons. Let's look at the first one, which is UNH. So here's United Healthcare, has been doing pretty well lately. There's two reasons to sell covered calls. Now, number one, covered means you own the stock. So number one, you want to make income. You think the stock is not going to continue to explode higher. That's really important. You do not want something that moves quickly. You want something that's kind of going sideways or moving very slowly, one direction or the other. So the first reason for a covered call is to generate income, meaning you want a stock that may be going up. You don't want to sell your stock because it's done really well for you, but you want to generate some income from the stock. The other reason is to cure a mistake, cure a downtrend. In other words, if you thought the stock was going to go up, let's say right here, thought it was continuing to go up and you bought it right there, but instead it went down, well, now you're underwater. But if you sell a covered call, then it will generate income, but more importantly, it will lower your basis. So let's say we bought it here at 370 and we were able to sell a covered call for $10. Well, that now lowers our basis down to 360. And even though it continues to go down, and you can do that each month or each week, this UNH has weekly options. So you can do it every week and keep lowering your basis, lower and lower. In fact, you can theoretically lower your basis all the way to zero at some point if you don't get called away. Now, what does it mean to get called away? Well, that means you are making a bet that it's not going to go above the strike price or the target price that you think it will go to. So if we're right here with UNH and it closed at 367 and we sell a covered call for 380 right here, then and it starts to go down, then you keep the premium, just like the insurance company. So you will keep whatever the premium is. Let's say it's $10. I don't know what it is, but let's say it's $10. So it doesn't get to 380. You keep the $10 and you do it again. And you sell another one maybe down here at the 370 strike price, and it doesn't get to 370. You keep another $10, and you just keep doing that over and over again, every week or every month, whatever your time frame is. Some stocks have weekly options, and UNH does. So you can generate that $10 to either generate income or lower your basis to cure a stock that has moved against you, basically. So those are the two reasons to use covered calls. Now, when do we use covered calls? So if you watch that video that I did on Technical Tuesday, it will explain how to use technical analysis for covered calls. And what you want to do, if you want to generate income, you want to sell the covered calls near the top, because you actually want it to go down so that you can keep the premium and keep the premium as high of a premium as possible, which means closest to whatever the price is. And then if it starts to go down, you just keep the premium. And if that premium was, let's say it was a weekly premium in this case, so 1 week later, it would expire worthless. You keep that premium and you do it again. It expires worthless, you keep the premium and you do it again, week after week. So that's how to generate income. So using technical analysis, clearly you want to sell the covered call when the price is near a top. So you want to do it when the RSI, like this, is near a top and starting to roll over. So you see right here, it's all the way up here. It's rolling over below the 70 point. It did it right here. So you could sell a covered call here, and you can do it very close to what the price is. So in this particular case, on this day, when this red bar is starting to move lower, you can see the RSI is moving lower. Then you can sell a covered call right here. It closed at 354. The day before, the high was 376. So you could sell a covered call for 370, let's say for a month later. And even though it went above 370 here, actually, it went to 381 right there, but the month wasn't up yet. And then it started down. So you would keep the premium, generate income, and you would keep the stock. So then as the stock moves down, you could do it again, month after month or week after week, and just keep generating income. But when you want to do it is when all of the indicators are at the top, starting to move lower. You don't want to sell a covered call when they're at the bottom, like over here, and moving higher, because what would happen is, let's say we did it when it was all the way down here, and we sold a covered call for, let's say, 250. 250 is right there. Well, just 4 or 5 days later, it went above 250. So you would have been called away. So you'd be out of the stock right here. You'd keep the premium, sure, but the goal is to keep the stock and generate income. So you don't want to be doing it when the indicators are near the bottom. You want to be doing it when the indicators are near the top and it's starting to roll over, so that you can sell your covered call close to the price and not get called away. Keep the call and keep the stock. So what would we do with UNH right now? Well, first of all, the indicators are at the bottom, so it's probably not a good time to sell a covered call on United Healthcare, because it's probably looks like it's starting to move higher. So you want to see if it moves up and then starts to roll over. It might be doing that right at the 21 right here. So if you were to sell a covered call on this, yesterday's high was at 343. So let's say we would sell one right here at the 50-day at 340. Let's call it 350. Sell a call for 350. Let's go down here and look at the options chain. This is the one for stock charts. So I recommend you look at the options chain in your own platform. And then next you want to pick a price. So if I'm doing something on a short-term basis, let's go about 2 weeks out. This is 15 days out, November 28th. And the 350 calls are on the left side. 350 is right down here. So you would sell this one for $3.95, roughly about $4. So you can make $4 right here, and you have to have at least 100 shares. So let's say you have one contract, 100 shares, then you would make $400 in the next 2 weeks, as long as the price does not go above 350. Now, 350 is up here above the 50-day moving average. So it could go up, get rejected, and start to move down. If it does, you keep your $4 or $400 in the next 2 weeks, and you do it again. So you can just do that over and over again and continue to make more gains. So that's the way you would do it on UNH. The other stock is Eli Lilly. Lilly is a little bit different since it has been on a tear, just continuing to go higher. Notice the RSI is near the peak up here. It has not yet rolled over though. So it would be a little bit risky because the stock is still moving up right now. Be a little bit risky. The high right now is 1,033, let's call it. And let's say I wanted to sell a covered call. Now, in this case, this is one you really want to keep. Contrary to what I said before, that you want a short term because you take advantage of just keeping the premium. In this case, you might actually want to go much longer term. So let's say we wanted to go out, in this case, to January 15th. Let's go January of 26. Let's go even further than that. Let's go December. Let's go December of 26. So that takes us about a year out. So December of 26, in this case, the high was 1033 roughly. So let's look at where 1033. So 1040 is the next level right here. 1040. So remember, this is a year away. If you don't think it's going, if you think it's going to pull back below 1040, in this case, you'd make $165. So $1,600 if you have one contract. If you have 100 shares, you make $1,600 as long as next December it does not go above 1040. Now, do you have to wait till December? No, absolutely not. Anytime between now and then, if it pulls back, the further down it goes, the more that you'll make here. You're not going to make the whole 165, but let's say you want to make 50% of that. So let's say $100, a little more than 50%. So you just hold on to it till it gets to $100, or let's say it gets to $65, so you make $100 profit. So you would then sell it. You would sell the covered call at 165. You'd buy it back for 65. As the price goes down, the value of the call goes down as well. So if you think that the price is going to go down, you want to keep the stock. This is one way you can do it on a very long-term basis. And you don't have to wait the whole year. You can do it at any time. As soon as you're at 50%, you can buy it back and close your position. Now, what if we did want to do it on a much shorter term? What if we did want to take it to, let's make it the monthly expiration of December 19th. That's 36 days away. All right. And again, we'll use 1033 or the closest to it. In this case, it's 1040 again. So we sell a covered call, make $41 in this case. So what if it did go to 1040? Well, you've already made the $41 in premium, so you're actually selling it for 1080 if it goes above 1040 before December, before this strike price date, December 19th. So right now it's still the RSI is still above 70 and has not yet rolled over. So we don't know. Yeah, let's look at the, yeah, so none of these momentum indicators are implying that it's rolling over yet. It's still going higher. You could take a chance and do it right here. So the high was 1033. So 1040 is what you would be selling it for right up here. So you're banking that it's not going to go above 1040 in the next month, that it's going to start to roll over, but it has not yet started to roll over. So you don't know. This could just continue to go up. What that means is if it does go up in the next month and it ends above 1040, then you will be called away. Let's say it ends at 1050 by the expiration in December. You will be called away. You will make the 1040. You will sell your shares at 1040, but you have a premium of 41, so you'll keep those. So you're essentially selling out at 1080 if it were to do that. Now, could we make that a little bit higher to be a little bit safer? Sure, we could. Instead of 1040, let's say it's 1100. Let's say we don't think it's going to go to 1100 within the next month. Well, in this case, you would make $21. That could be a safer play. It's about half as much as what you'd make, but you are probably more likely for it to expire worthless. In this case, if you go to 1100 in the next month, more likely to expire worthless, and you just keep the 2170 times however many shares. So if it's 100 shares, then it's $2,000. You would keep it over the next month. You'd make $2,000 and you'd keep your stock. So that's another way. That's probably a safer way, although you'd make less money, but it's probably a safer way to do it. But what I would do is wait. Maybe you're banking, you're taking the risk that this is the top, and nobody knows. No one knows when the top is going to happen. So what I think I might do is wait for a dark blue bar like this, wait for momentum to start to roll over, and then do the covered call, because it's more likely not going to get back up to that level. You could then place it a little bit closer rather than 1100. You could place it at 1040 and lower the risk of it actually being called away. You can also put it at 1080, kind of in between. And in that case, you'd make $27 times however many shares. So if you have 100 shares, that's $2,700 you make in the next month, and keep your stock. And just do that over and over again every month. So $2,700 a month, potentially, if you could do this every month. You can't do it every month because stocks ebb and flow up and down. And you can see, like I said before, you want to do it when it's near the high, so it's coming down, so you keep the premium. Well, that's not going to happen every month. So you're likely not going to be doing this strategy every month, especially if you're doing it on a monthly or a weekly basis. But you could certainly do it every other month. But you want to wait for the indicators to show that it's starting to fall, starting to go down. You want to be doing this strategy at the top, not at the bottom. All right, so that's how to do cover calls on those two. Both of those stocks are looking like they're moving higher. United Healthcare, this let's look at this on a weekly. There's and you can see it's now well above its previous monthly. It's well above its previous all-time high, which is right back here at 964. So it could easily, it likely will come back to that support line at 964 or 950, roughly around that area. It very likely will come back to that area and then start to move back higher again. But right now it's at the top of the channel. This is a weekly chart, and the week hasn't ended yet, but all week it's just continuing to move up. You can see it on the bar. Also, the other way to play covered calls is to look at the Keltner channel. And right now, Eli Lilly is at the extreme. It's at the 4x level, 4x ATR, average true range. So this is likely near the high. You don't know if it's exactly the high, of course, but it certainly looks like it is overextended right now. If we look at UNH using the Keltner channels, it's right in the middle. So UNH actually has more room to run. You see where it went up here to the 2.5x level, that's the red line, and then it reversed and went all the way back down to the bottom, right down here. So covered calls using the ATR, you would want to do it when it's near the top, when it's up near close to this 2.5, the red line, and starting to roll over, which happened right back here. UNH looks like it is trying to make a recovery, but still below all of its moving averages. So it still looks pretty weak in general. This is on a weekly chart. All right, that's it for now. Let's take a look real quick at what the markets look like. There's the NASDAQ, just kind of, it's currently 1205 on Thursday. Here's the S&P, I'm sorry, Russell. Looks the same as the NASDAQ 100. Money flow is down near the bottom. Does not look like it's turning around, although it's starting to flatten out a little bit. So maybe the second half of the day, it might come back a little bit. And then the S&P looks very much the same. S&P starting to round out the bottom. So it might start to move higher by the end of the day. We'll see. And which would be good if it did, but needs to get above these moving averages, and money flow starting to pick up a little bit. But looks like it's, the rotation is still out of growth and into value right now. So, and that's been happening for a while. It's been very subtle, but it's been happening for the last couple of weeks. So that's what Wall Street does. They sell to retail traders over a period of time. They don't do it all at once. And then at some point, everything just kind of falls through and the market then collapses. I don't know if that's going to happen, but here's the S&P right now, continuing to go down, sitting right on the 21-day EMA. So important level today. We'll have to see if it can reverse or not, but keep an eye on it. You can see the negative divergence as the price makes new highs. The momentum continues to make new lows down here. Still above the 40 level, which is the key for a continued uptrend. Has not broken the uptrend yet until it goes below this 40 level. But it's putting in lower highs each time. So it looks to me like it's going to do that pretty soon. And the VIX continues to move up. So that's it for today. Good luck trading. We'll talk again tomorrow. Let me know if there's anything you'd like me to take a look at. Be happy to do that. And I'll talk to you tomorrow. Take care.